Good morning, everyone. Today is February 25th. We got a lot to talk about. The market sold off about 1,000 points yesterday. It was a big day. Why? Because coronavirus is sticking its ugly head again. As of right now, about 80,000 people worldwide have been infected. 2,700 have been killed, mostly in China. But news of clusters around the world is rattling the markets. Here's the problem, manufacturing. There's a big manufacturing. Look at this. In smartphones, an industry that relies on China to assemble almost all of its handsets, some component suppliers' production is as low as 10% of its normal level. So you're having a major bottleneck, even with countries that are not impacted because of this bottleneck. And this is going to impact production. And what we don't know is how much this will impact overall, how much long-term this will have. It's completely unforeseeable. Travel, retail, businesses in China are not doing well. This may start impacting companies like Apple because of the transition of semiconductors back and forth. It's not a ideal situation. As a matter of fact, the problem with these, here's the thing. Markets cannot appreciate or anticipate or appraise in their value anything that's unforeseeable. And unfortunately, these viruses, we don't know the full extent of it. We don't know how much we really know, how much China is telling us. We don't really know for another month or two how much it's going to impact production. We don't know how much it's going to impact earnings. So there's a lot of question marks here, and that's why the market is running amok. But getting back to local data, retail sales. Remember, retail numbers make up 70% of the economy. Home Depot, this is a very important stock because Home Depot has a lot to do with production. And same-store sales surge. And retail typically reports last. They're the last to report, and they're the ones that typically give the S&P that nice boost before the end of the year that's caused by the retail sector. So the retail sector is very important to look at, and especially in light of the fact that we have our quarterly GDP report this Thursday. So Home Depot's doing better than expected. So far, if you were to take USA and isolate it from the rest of the world, which obviously we can't do, we're totally relying on China and other countries for supply and demand. But let's say we were just solely in this country, things are not doing bad. In other words, if this coronavirus goes away tomorrow, this is a very good number. If the coronavirus wasn't putting a wet blanket on the market, this would probably cause the market to rally. That's not all. Something else. Strong fourth quarter for Macy's. Macy's has been strongly underperforming the market lately. Shares are up 3% before the opening. They announced they're going to close 125 stores, cutting 2,000 jobs. But the corporate numbers are doing better than expected. That's very important as well, and that's going to help drive the market higher. Let's talk about technical factors. If you look at the sectors, there should be no surprise here. Utilities are leading, retail is leading, consumer staples are leading, material is leading. Look where the discretionary, the speculative sectors are. Communication services, consumer discretionary, information technology. They're all at the bottom. And that's where they should be. They shouldn't be at the top. They should be at the bottom because the market's rally. This fragmented market that we've been seeing for the last month and a half, where technology and utilities are next to each other, that's not normal. That's not healthy. That's not how markets trade. Utilities are leading. Defensive is leading. Consumer staples, utilities is leading. Material, industrial, healthcare, those are defensive. They are leading. And speculative are at the bottom. That's how it should be. That's very normal for the current market cycle. And this is why when we were looking at a monthly, right here, let me show you the monthly, it's still, because we're looking at an average, you see? Let me show you this. We are looking at the average, and the average takes into account what happened 6 months ago. And 6 months ago, technologies rallied 23%. So that's what's causing it up. If you were to look just at the last month, look at how it looks. Let me show you. Utilities. Again, technology. No, this is wrong. Okay, now we got it. Real estate, utilities, consumer staples, then consumer discretionary. In other words, technology and consumer discretionary are not at the top. They're not. Utilities and technology are not next to each other. Again, the average kind of distorts it, but we know that, we take that into account. Now, volatility rallied only to about 25. You would figure with the market going down 1,000 points, volatility would be a lot higher. And excuse me, it's already slated to come down. If we trade below 22 today on the VIX, which is very likely, there's a really good chance volatility is going to go down. And if we break 22, I'm going to start looking at put options for volatility. I think volatility is going to come back down. That's number one, and that's huge, okay? Number two, S&P 500. We traded below the 50-day moving average. This morning, we did not. This is the overnight data right now. We did not break the low. We're close, but we didn't break the low. If we break the low, there's a good chance we're going to hit the 200-day moving average. Now, folks, if you're surprised by what I'm telling you right now, if you're surprised, if this is shocking, if this is news to you, I'm going to show you something that I've been showing anybody who would listen and watch me. I would show you this. Remember the NASDAQ index? Remember what I was telling you? How momentum levels were at the highest level? Momentum levels before this little downside correction? Let me show you this. Let me show you the 5-year chart. Remember I was showing you how this is the highest level. We had 85% of stocks in the NASDAQ 100 trading above the 200-day moving average, whereas the overall market, it was like 60%, 85%, 60%. And I showed you guys, anybody, look at any of my videos going back a month. I was telling you that momentum levels are at the most overbought levels we've seen in 5 years. We haven't seen momentum levels like this since January 2018 and 2018. And look at what happened to the market. Momentum levels just went up. They're slated to come down. I don't know if they're going to come all the way down to 10. That's kind of low, but I think we are going to see them jump to the 200-day moving average right here, which would put the NASDAQ 100, let me just show you the graph of the NASDAQ 100 here, which would put it right at the 50-day. The NASDAQ 100 is still very resilient and is very strong, and let me show you daily data. There we go. It's just now hitting the 50-day line. It's still above or at the 50-day line. Now, here is my prognosis, and here's my advice to you. Let me just go back to the SPY. Most of you are going to be trading the SPY anyway. But if you're looking at the SPY, let me go ahead and put that here. If you're looking at the SPY, what you want to do is, this is yesterday's data, and this is today. We're below the 50-day line. I would wait and put an alert at the 321 level. If we break 321, all bets are off. But if we stay within yesterday's range today, we're already there right now overnight, and because the market's a little higher, about 1/8 of what it lost higher, as you could see right here. So it's got about 7 more parts to it's got a lot more upside. But here's what I'm looking at. I'm looking for a close above this blue line 2 days in a row. Till I see a close above the blue line 2 days in a row, I'm going to consider the market bearish or twilight zone-y choppy. That's my prognosis. So again, if we break, let me get rid of this here. If we break this level right here, where that red line, oops. If we break that line right there, the 321 level to the downside, if we break yesterday's low to the downside, I don't think it's going to look very pretty. Can we? Will we? Momentum levels are telling us we got more downside to go. But it may not happen overnight. Again, this coronavirus may last and last and last. But right now, I believe we're going to fill this gap on the bond market, and we're going to fill this gap right here, and we're going to start trading lower. I don't think we're going to get too far above these levels, especially with the divergence we're seeing in the RSI. Let me show you what I mean. Higher highs, lower highs. Hey, where did we see this recently? Maybe the S&P 500 before it sold off. Maybe the Dow Jones, the S&P, and the NASDAQ before the Dow Jones sold off. That's right. This is divergence. Higher highs on the price action, lower highs on momentum. Momentum levels cannot generate this momentum levels. That is telling us markets are overbought. Well, think it's a coincidence? Let me show you something. And again, oh, I didn't even undraw the line from the other day. What a coincidence. Higher highs, lower highs, just like the bond market. Exactly the same thing. And what happened to the stock market when we saw this? It went down. And now I'm thinking the same thing's going to happen to the bond market. Again, higher highs, lower highs, divergence. So here's what I'm looking at. I'm looking at fundamentals that are strong. I'm looking at, so far, not a major impact to the US economy. I'm seeing the market anticipate things ahead of time, but fear levels, they're just not going much higher. So if we see the fear level break below 21, there's a good chance we're going to go back down, and this may be it. Again, it's hard to predict global economy, but markets are still fragmented, and I believe tech has more downside to go before we're done. But it doesn't mean it's going to happen tomorrow. It may happen over the next 2 weeks. Right now, my suggestion is to be nimble. Very, very, very nimble. And speaking of nimble, if you want to learn how to be nimble in this market, check out this trader. His name is BT, and he recently revealed something very, very cool to me. It's a 24-hour strategy. It's not day trading. You're not in and out the same day. It's not day trading. I'm not a big fan of day trading. But you're in one day, you're out the next day. That way, you minimize your exposure to the market. And this strategy has the potential to deliver triple-digit gains in no time. In no time. Nimbleness, in and out in 24 hours, hit and run type of strategies. The goal is to see massive moves and walk away with beautiful gains the next day. You make a trade on Monday, you get out on Tuesday. You get in on Tuesday, you get out on Wednesday. You get in on Wednesday, you get out on Thursday. That simple and clean. The strategy is easy and simple to use. It'll help you reduce risk since you spend less time in the market and you're not going to be trapped in these major movements when the volatility goes 1,000 points. So again, it's nimble. You're not spending a lot of time in the markets. It's a very cool strategy because you're in and out in 24 hours. It's got the potential to give you explosive triple-digit gains, and it's low risk because you're not in the market a long time. Follow the link below. Check it all out now. Do it now. This BT trader's the real deal. He's a really cool guy. He knows what he's doing. He's kept a low profile, but he's finally coming out. Check out BT's strategies. They're really, really cool, and they can really show you how you can make explosive triple-digit gains in no time. Folks, the key word right now is being nimble. Being nimble. And this strategy helps you being nimble. Follow the link below. Check it out now. Talk soon. And by the way, if you like this video, send me feedback. Support at marketgeeks.com or like the channel. Talk soon. Bye, guys.